The United States government just blinked. For 5 decades, the financial world has insisted that silver's price is decided by screens in New York, by paper contracts, lightning-fast algorithms, and mountains of derivatives. They said physical metal was irrelevant. There was always enough to satisfy demand. Today, Wednesday, January 14th, 2026, that fragile story shattered. An official notice from the United States Mint, the agency that actually produces the nation's coinage, arrived like a public admission. Retail sales of silver numismatic products have been suspended. I'm your host. Short analysis, no fluff. This wasn't a routine update, it was a systemic alarm. If the Mint, backed by the Treasury, pauses silver sales because it can't price its coins, you're watching a bureaucracy concede that market volatility outran its control systems. The $89, 67 flashing on the screen is moving too fast for procurement rules and accounting cycles. But the meaning goes deeper. A halt in sales at the Mint strongly suggests a physical shortage. When a manufacturer refuses to sell during a spike, it's often because it can't replace the metal at tolerable terms. If the Mint sold a coin today and the underlying ounce gaps higher tomorrow, it would be out the metal. The government chose to hold the ounce rather than accept depreciating paper. Imagine a grocery line where the clerk stops selling milk because the price is rising too quickly. The clerk prefers to keep the cartons rather than take cash. That image explains why the Mint's choice reverberates beyond the coin market. Private dealers watch the Mint as a baseline supplier. If the official source freezes, every private seller immediately rethinks inventory strategy. Premiums rise. Out of stock, signs spread. The supply chain that once trickled metal to the retail buyer tightens into a trickle, then a drought. While the Mint shut its door, a parallel and more violent event played out behind the exchange screens. Depository statistics show a coordinated large-scale withdrawal of physical silver from major commercial vaults. The largest custodian in the system, long viewed as the delivery backstop, recorded over 3 million ounces physically removed in a single day. That wasn't an accounting shuffle. Those ounces left the vault in armored trucks. Other vaults reported heavy outflows too. Across depositories, nearly 8 million ounces disappeared from the exchange system in 24 hours. Why would a major holder withdraw hundreds of thousands or millions of ounces? The simple answer is counterparty risk. When you store metal in a third-party vault, you rely on the custodian's integrity. But if you suspect rehypothecation, leasing, or any encumbrance tied to aggressive shorting, you reclaim possession. Owning metal on a ledger isn't the same as holding it in your hands. Those withdrawing parties signaled they preferred physical certainty to paper promises. Even more telling is where the metal came from inside the vaults. Withdrawals disproportionately hit the eligible category, metal owned outright and stored for long-term holders, not the registered pool earmarked for futures delivery. Eligible ounces are supposed to be sticky. They rarely move. When long-term holders begin moving eligible metal in million-ounce blocks, you're witnessing a flight from paper trust to possession. That is institutional panic, or at least decisive repositioning. Where did the metal go? The market gives us a clue. Asian physical markets are bidding far more than Western paper quotes. Reports from street markets indicate bids near $100 per ounce, roughly an $11 premium versus the $89 COMEX figure. When a sustained arbitrage exists between New York and Shanghai, physical flow follows the money. It is economical to buy in a cheaper venue, take delivery, ship to the higher bidding market, and lock a tidy profit. That behavior drains Western inventories rapidly. This is the math that forces a reconciliation. You can print paper shorts endlessly, but you cannot create physical ounces. Each day an arbitrage persists, more metal heads east until the Western system cannot meet contractual delivery demands. The Mint's suspension is not an isolated procurement hiccup. It's a symptom of a supply chain already hollowed by export flows and strategic accumulation. The psychological effect compounds the physical reality. The Mint's announcement and the wholesale withdrawals communicate a powerful message. Institutions with scale and inside knowledge are moving to take possession. Retail buyers react to both numbers and signals. If the Mint won't sell and big holders are withdrawing metal, the crowd assumes scarcity and rushes to buy whatever is available, widening premiums. That creates a feed-forward loop. Higher premiums induce more urgency, which raises premiums further. And let's be clear about the current two-price world. Western screens read roughly $89, 67 mm. In parts of Asia, physical bids sit close to $100. Two prices for the same atom cannot persist indefinitely. Either the East drops its bid, or the West's paper price must rise. Given industrial demand, strategic accumulation, and the incentive to arbitrage, the likely outcome is the COMEX price moving up to meet the physical price. That repricing can, and likely will, be abrupt and violent. The procurement mechanics matter. The Mint buys blanks and refined silver from private suppliers operating globally. If those suppliers can earn more by selling to Asian buyers or industrial customers, they will prioritize those offers. A bureaucratic purchaser with procurement limits cannot outbid global strategic buyers in real time, so the mint legitimately finds itself outbid for the raw material needed to mint coins. When a government cannot secure its own coin blanks, that's a symbolic and practical rupture. There are parallels to previous tight market episodes. When essential industry demand pivots dramatically, pricing moves from spreadsheets to shipping manifests. Palladium's historic surge is a cautionary precedent. Once the auto industry increased demand, the market revalued the metal faster than many expected. The mechanism is consistent. Physical demand backed by industrial necessity overwhelms paper narratives. Recycling is not an immediate fix. Industrial silver is often dispersed in tiny amounts across electronics, coatings, and modules. Recovering those ounces is costly and slow. Ounces locked into products won't re-enter the market quickly enough to close an abrupt deficit. That dynamic extends the duration of scarcity and magnifies short-term pressure. Policy reactions are possible and consequential. When strategic materials tighten, governments may declare priority allocation, impose export controls, or direct supply to critical industries. Such moves alter market dynamics and may curtail retail access further. Rationing and prioritization are messy politically and economically, but they become plausible if domestic industry risk is high. For market participants, behavior must adjust. If you hold physical metal, custody now matters as much as ownership. Bank storage offers convenience, but introduces potential rehypothecation and counterparty risk under stress. Consider private, non-bank vaults or direct possession for critical ounces. For holders of paper exposure, ETFs, futures, or unbacked derivatives, consider converting a meaningful portion into deliverable metal if your view is structural shortage. If you're a new buyer, avoid panic purchases at extreme premiums. Instead, stagger buys to manage entry cost and liquidity. On the equities front, miners can provide leveraged exposure, but perform unevenly. Many producers have hedged future production, locking in lower prices that limit upside during a spike. Favor unhedged producers, firms with clean jurisdictions, and near-term expansion capacity. Jurisdictional stability will be a premium attribute if resource nationalism rises. Track 3 critical indicators: exchange warehouse stocks, retail dealer premiums, and Asian physical bid levels. A falling warehouse count, rising premiums, and sustained high bids in Asia is the clearest configuration signaling a persistent physical squeeze. When those three align, expect the COMEX to be forced to reprice or face delivery failure. Trading tactics should shift as well. Mean reversion strategies that rely on abundant liquidity can fail in a regime dominated by physical scarcity. Event-driven approaches, focused on miners with operational leverage and minimal hedging, plus option strategies that limit downside while preserving upside, are prudent in the near term. Prepare for large, opening gaps, headline-driven volatility, and acute margin moves. The wholesale withdrawals are a smoking gun. They show that well-capitalized actors prefer possession. They are not net sellers at these levels. They are loaders to the trucks. That behavior removes the floor the paper markets once relied on. The result is a market where retail buyers, dealers, and bureaucratic buyers like the mint all compete for a shrinking pool of deliverable metal. Don't be seduced by spot quotes on a terminal. Real buying cost is spot plus premium. If dealers are quoting $110 for a coin while the screen reads $90, the true acquisition cost is the $110. In scarcity, premiums, delivery timelines, and jurisdictional security determine effective price more than the instantaneous COMEX reading. Finally, act with measured urgency. Panic buying into outrageous premiums invites regret. Doing nothing while the market shifts invites opportunity loss. A balanced plan, securing a core allocation to physical metal while preserving optionality through equities and sensible derivatives, fits most participants. Keep liquidity available, protect against custody risks, and monitor the physical flows daily. We are at a hinge point. The mint suspension was the public trigger. The vault withdrawals confirmed informed actors are taking possession. That combination changes market mechanics and investor calculus. Expect headline volatility, widening premiums, and rapid repricing as the paper market struggles to align with physical reality. Possession now matters more than paper assertions. Think of recent market shocks. When an industry suddenly needs a specific metal, the paper market loses authority and physical movement decides value. Palladium's surge in the 2000s showed that demand from a dominant industry can reprice a metal almost overnight. The lesson is simple. Screens can signal, but only shipping manifests settle the score. Recycling will not provide rapid relief. Most industrial silver is dispersed in tiny amounts across electronics and solar panels. Reclaiming it is costly and slow. Ounces tied up in products today won't return to the market fast enough to meet an abrupt increase in industrial appetite. That delay magnifies the present squeeze. Metal removed from circulation today stays offline for years. The market also contains dangerous feedback loops. As premiums rise, speculative capital and retail FOMO increase demand, pushing premiums higher still. Dealers seeing outflows raise prices. Buyers chasing returns accelerate the spiral. Regulators then face awkward choices: rationing, export controls, or prioritizing industry, each of which can deepen the shortage or spark political blowback. Custody is now a central concern. Bank storage offers convenience but introduces counterparty risk. Rehypothecation, regulatory holds, or political seizure are non-trivial threats during stress. Private vaults or personal possession remove some of those risks. If you hold paper exposure, consider converting a portion to deliverable metal to ensure absolute ownership. If you are new to the market, avoid buying at peak premiums. Accumulate in staged purchases as premiums normalize. Equities offer leverage, but due diligence is essential. Favor miners with minimal hedging, strong balance sheets, and assets in politically stable jurisdictions. Companies that sold forward future output at low prices will not benefit from a spot surge. Jurisdictional security will matter more than resource size when nations prioritize domestic supply. Watch 3 indicators closely: exchange warehouse stocks, retail dealer premiums, and Asian physical bid levels. A falling warehouse count, rising premiums, and steady Asian bids signal a structural shortage. When those align, the paper market will be forced to reprice quickly. For traders, the playbook shifts away from standard mean reversion to event-driven strategies. Expect large gaps at open, acute volatility, and headline-driven moves. Use options to limit downside and retain upside. Size positions with a clear plan to manage margin calls and extreme swings. Above all, act with discipline. Panic buys into exorbitant premiums can cause regret. Standing aside while the market accelerates can cost opportunity. A balanced approach, securing a core physical position while keeping optionality through carefully selected equities and hedges, is prudent for most participants. The Mint's suspension and the wholesale withdrawals are not isolated anomalies. They are symptoms of a deeper regime change. When institutions begin preferring possession over paper claims, market mechanics shift. Prepare for volatility, monitor the physical flow data, and remember, in a scarcity-dominated market, possession truly matters. Subscribe.